Look, I think it's to be aware that potentially we're moving into new uncharted territory. And I think you pointed it out. Many people consider it just noise. Now I think the realization comes in that potentially downside risk could be more significant. So what that means for portfolio construction, we have been looking at unconstrained active managers that potentially will benefit from higher volatility, because I think volatility most probably will increase significantly. And many portfolios are still somehow positioned for low volatility markets. So active investment strategies that benefit from higher volatility potentially would be preferred over passive ETFs that are net long only. So I think now is the time to also look at tail risk. In case there is more dislocation in capital markets, do you have some hedges in the portfolio?
Simon, when we look at this more broadly, Sri was mentioning that there's the fear that this could metastasize, that we're moving obviously into this uncharted territory. When we look at what happens next, particularly with this tit for tat between U.S. President Donald Trump and the Chinese premier, when you look at the currencies, the potential for a currency war as well, there are a lot of talk about using currency as a weapon, but of course, with any weapon, that could potentially backfire as well, couldn't it?
I mean, the People's Bank of China has a delicate balancing act with the RMB. I do think the RMB is probably overvalued at the moment. It has been following the US dollar up, while many of other similar currencies have been going down quite substantially. So on a trade-weighted basis, the RMB really is too strong and should come down a bit. So I don't think we need to be too worried about that in the international markets. The worries, though, for the Chinese central bank are domestic, that if people within China think that the currency is set for a free fall, then you get that pressure for the capital outflows and capital flight ramping up. That's what the People's Bank of China is trying to avoid. So depreciation is a good thing as long as they can maintain those domestic animal spirits.
Michael, do you agree? Because sure, you've got the concerns about capital outflows on the one hand, but what about the big Chinese corporates that have to face dollar-denominated debts?
Yeah, and that is a big question, and this is also where, to some extent, some rating agencies had concerns with regards to systemic risk in China. But then, so far, it was always considered too big to fail, and they will muddle through. But that assumption potentially can be tested, and I think also the Beijing leadership most probably will allow some more corporate bond defaults to basically have more market discipline. And I think that's also what we need, more market discipline. I mean, this whole idea that markets can only rise, I think it's already misplaced. I think we had a lot of QE, quantitative easing, that is now leading to quantitative tightening, and with that will come some potential capital market dislocations.
Randhir, when you look at what happens next, how do you build this forward-looking portfolio?
Look, I mean, it comes down to questioning key assumptions. What actually worked in the past might not necessarily work very well going forward. I think if you look at Mr. Trump's policies, one of the key things, it is actually benefiting more the American worker than American or global corporations. And that is actually good for the American worker, and also means that from a stock selection point of view and sector call, it is more domestic U.S. industries, and those where higher wages feed through to the American worker. Because I think this whole Trump debate about global trade is that corporations have done very well, as we see in the S&P 500, but the American worker has lost out, and he's trying to sort of change that slightly so the American workers most probably will have higher wages. So wage inflation, or wage growth at least, it should be a positive thing for American workers. So anything related to that, other sectors potentially could see headwinds.
And one sector in which President Trump has said repeatedly he wants to help the American worker in is the automobile sector.
Yes.
Yet we've heard from General Motors on Friday saying actually these tariffs could be detrimental. They could result in job losses. We've heard warnings from the likes of Moody's on that too. And Simon, I want to bring you back into this because you made the point at the very top of the show about how vulnerable the auto sector is to these tariffs. But is President Trump actually hurting one of the industries that he pledged to protect here?
Certainly he would be hurting large parts of the US auto sector. So other parts would benefit. I mean, auto is set the central of this trade dispute because on one hand, it's very politically sensitive, it's very iconic, and people's auto brands are very associated with national psyches in all countries. But at the same time, it's also very internationally integrated. Auto supply chains are very, very international. So the problem that Trump and the US industry will face with tariffs on any EU imports is many of them are going to be intermediate goods, and so they're imports that are going into US cars. So it's going to make US cars more expensive to make at the same time as the prices of imports are going up. So it's just going to result in higher prices at the end of the day.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.